Hi everyone, welcome to today's video. So today we are going to discuss a very interesting case about OYO's IPO. I'm going to give you my verdict whether I'm going to invest in OYO's IPO. I will do a detailed analysis of OYO's business model, why they have launched this IPO, what are some of the key problems that OYO is facing currently, and we will make a call together whether or not to invest our hard-earned money in this IPO. Before I jump into the nitty-gritties of OYO's business model, let me share a very small anecdote with you. So approximately a couple of years back, there was a company called as Uber Eats, and it was operational in Delhi, and I used to order like a lot of stuff from them. Not because the company was good, because they were giving some kind of insane deals. For example, and I'm not kidding, honestly. So I ordered literally for a month waffle, a chocolate waffle, really sumptuous looking chocolate waffle at 10 rupees. 10 rupees, I'm not kidding. I ordered that multiple times from Uber Eats. 10 rupees chocolate waffle. Can you imagine? There was a person who used to make that waffle, get it delivered to my home, in total 10 rupees. This is madness. This is not how businesses should be done. Of course, I as a consumer enjoyed it, gained a lot of weight by eating those waffles. But bottom line is that this is not a definition of a good business. What eventually is a business? A business serves essentially two purposes. One is that a business helps you make more money. So whoever is running the business should be making money in the process, getting profits, distributing that profit to the shareholders or investors. So that is one goal of a business. The second goal of a business is to add value efficiently, right? Sometimes we mix all these things and come up with really complex business models. So I'm going to do a detailed discussion on where I find OYO to be on the spectrum. These are my personal views. You don't need to necessarily agree with these. I'm more than happy engaging with all of you in terms of productive discussions. So please drop in your comments. I will personally read and respond to as many comments as I possibly can. Okay, so let's get the discussion started. So first and foremost, what is it that OYO does? What is the major value proposition for OYO? Okay, so essentially you need to imagine OYO's business model to be something like this. On one hand, we have these really big hotels like Marriott, like Hyatt, like ITC. So all these are big hotel chains. They have very strong brand value, brand presence. These are very renowned names in hotels and hospitality space. All of us would know the brand value of Taj or brand value of ITC hotel. So that is very clear, right? And that is what the definition of hotels used to be. Then OYO came into the picture. What it started doing was that it started aggregating no brand or no name hotels onto its platform. So you have all these different hotels. They have very limited brand value. They do not have any specific reach. So you don't know these unknown names, right? So OYO gave them a brand value. They took the OYO sticker, stamped it on these no names hotels and started calling them as OYO. So that is the simple thing. So let me just draw this out in Majnu Bhaiya style so that you understand these basic points very clearly. Okay. So we have like hotels like ITC, we have hotels like Marriott, we have hotels like Hyatt, right? So these are all strong brand value, right? Brand value hotels. On the other hand, we have like literally no name hotels, right? No one knows about them. They are just surviving for the heck of it. And OYO comes and start giving these hotels an identity, right? So essentially, OYO becomes a parent to all these unbranded hotels and it converted these unbranded to a branded hotels. Unbranded to branded hotels. So in simple terms, this is the game that OYO played and it started scaling up very quickly. So currently, OYO has approximately 160,000 properties under it and it calls itself one of the biggest hotel chains in the world, which is fine. And they are spread across approximately 35 countries. So hearing all these facts, you will get super impressed that, you know what, massive growth. Yes, growth is massive, but the problems are also massive. But before we jump into it, let me cover some very specific points about what makes OYO so special. So according to OYO's management team, what makes OYO so special is that they are a tech play, right? So every company these days is a tech play. And honestly, in the name of tech, we can sell a bunch of different things. But bottom line is that OYO is essentially a platform, right? That they are pushing all these unbranded entities to come and use this tech platform, right, on OYO, right, and get listed here, right? So this is simply what OYO is trying to do. Now to facilitate this, what OYO does is that OYO does something called as minimum guarantee contracts, right? So minimum guarantee contracts, in simple terms, what it means is that, for example, if I have, let's say, 3 vacant houses or 3 really small, no name, no brand hotels, right? I have these 3 properties. Now I want to get listed on OYO, but I tell OYO that, you know what, I need like fixed income. You need to tell me how much money you are going to pay me in 1 year on one property. If I like the deal, I will sign up with you. Otherwise, I'll go to Zostel or I'll go to some other aggregator. So OYO then signs a contract saying that, hey, this is the minimum guarantee that Akshat, I'll pay you like 5 lakh rupees per year per property, right? Per property. So technically, by taking 15 lakhs from OYO, I have rented out these 3 properties or subleased these 3 properties for OYO. Now OYO will come, put a big banner on these 3 properties, start calling it as an OYO hotel and will start taking bookings. So this minimum guarantee mechanism helped OYO generate a lot of suppliers, right? Suppliers of what? Of hotels. Because essentially, if ITC has to build a hotel, what will it do? It will have to personally invest its money in terms of building that hotel. OYO is also doing it. I'm not saying OYO is not doing it, but predominantly it gets majority of its supplies through this minimum guarantee program, right? And now you're smart. You would have watched my yesterday's video also on high capex businesses. So you tell me, is OYO a high capex business or not? High capex business or not? Answer yes or no. It helps me understand that you're learning something from my videos. And also watch this video till the very end. You are seeing a live demonstration of a high capex business and what type of problems that they will get into. Okay, so essentially, is OYO high capex business? The answer should be yes. It is a very high capex business because every time it signs on this minimum guarantee, it incurs somewhat of a fixed cost expense. Super important point. Please remember this because this has become one of the key flash points in OYO's journey and why it is struggling. Now, just to wrap this point up, now OYO is promoting itself as a tech play. It's saying that, you know what, we have like such a wonderful platform that it's offering so much convenience to customers because you guys can get discovered so easily and quickly on our platform. You should sign up with us. So all the suppliers should be flocking to OYO, but that is not happening. OYO had to institute incentives like minimum guarantee and bunch of other different things to incentivize these suppliers. And even these suppliers are very conscious because suppliers on one hand and OYO on the other, what is happening, right? If 100 rupees are coming, when OYO would have started, they would have been giving more commissions. Let's say 50-50 to suppliers and 50 to OYO. Now with time, as OYO gains more strength, here the strength keeps on going up, OYO is going to cut out the supply, right? They are going to take 75% rupees and they are only going to pass on 25% to their suppliers. Suppliers understand this, right? This is like such a common play now. Everyone is aware of this strategy that the aggregator platforms, they are going to aggregate everyone and start squeezing people on commissions. That is how OYO will become more powerful and prominent. So now it's very interesting for us to take a look at the financial numbers. Here are the financial numbers for the last 3 years. This has been picked up from the IPO filing that OYO has done. So you can take a look at 3-year data. So financial year 19, there was no COVID problem, nothing. And take a look at the loss. So the loss has been approximately 2200 crores, 2300 crores approximately. In 2020, the loss was 11,000 crores. Now the loss is 4,100 crores. Now, interesting data point is that if you take a look at the total income, which is the revenue is 4157 and the loss after tax is 4102. Which is massive. Why is this happening? Because OYO, again, is a high capex business. All the inventory that they have built of 160,000 hotels, they are taking massive loss on it in terms of managing their existing contracts. Now, why is it that despite having 160,000 properties under it, so we are not talking about a small number, 160,000 properties and still the company has not generated any profits whatsoever. What are the primary reasons for it? Because, so with 160,000 rooms, you are not able to generate even 1 rupee of profit. That is just madness because OYO is not in growth phase anymore. It has already explored a lot of growth. So one data for that is that in 2019, and I'll put up the data in this sentence here also, that in 2019, the total addressable market for the short stay accommodation globally was $1267 billion. Meanwhile, OYO's serviceable addressable market currently stands at $772 billion. So approximately it has already explored 65% of the market that needs to be captured. So what I'm trying to say is that the number one problem that OYO is facing is that it has not explored a business model yet. It has expanded so fast, it is not churning out any money. It has approximately 160,000 rooms in an ineffective and inefficient manner. So this is the first key problem that OYO is facing. Now the second key problem that OYO is facing is that it is having issues with its suppliers. So suppliers were the ones, suppliers means that people who are supplying hotels or rooms to OYO, they were the ones who helped create OYO a brand. And OYO, because it is unable to service its minimum guarantee program, it is struggling to adhere to the contracts that it has already signed. Now here is an Economic Time article, so let me do a screen share and let me show this to you. And this was a very important paragraph that you should take a look at. This is a statement by an OYO partner. So he says that, so payments were anyways disrupted, forget this calamity. This calamity means 2020 COVID crisis. They have not been regular and they give some reason or the other. My property has been given on a minimum guarantee basis. I explained what minimum guarantee is, and payments have been an issue. This is just a publicity stunt. How will they provide these services? They have consulted hotel partners who own most of their hotels and their staff has already vacated property. So essentially, it's not as if that OYO is deliberately trying to trick suppliers. It is just that they are stuck on that fixed cost model that they have tried to scale up. And it is not working out for them. So therefore, they have to renege on that contract, payment terms, payment not being released on time. So what will happen with this? The most likely scenario is that a majority of these suppliers will move on to other locations and with other partners. So the third key problem that OYO is facing is that they are trying to cater to a customer that are very cost sensitive. So let me explain this by giving you an example, right? So you must have recently read, and I also covered this on one of my videos, that HUL increased the price of its product by 12%. Why? Because HUL can afford to do this, because the brand is not a value brand. That is not how they are building that brand. So Apple is notorious for increasing the prices of its product by 50%, 60% in a year. Why? Because Apple is a premium brand, right? They advertise themselves as a premium brand. Now we have OYO. Now how does OYO advertise itself? Budget, okay? So budget. Now, if they increase their pricing by, let's say, 500 rupees, what do you think will happen to their customer base? They will start revolting. So one of the worst ways in which you can design a business is that you start competing purely on price. Prices will only go down. Why? Especially in a case like OYO, because, for example, if you take a look at China, where OYO is present, what is happening there is that there are local supply chain that develop. For example, let's say that there is a company which is a small time player in China in some city and they own 10 properties. They only have to manage that city's property. They can do it more effectively. For example, if let's say I'm living in Delhi and I'm only looking at one particular area, let's say West Delhi. Now I have 10 properties there. I can become like a local player in it. I don't even need to hire any staff. I can run a super lean operational model and start putting out my hotels at a price of 500, 600 rupees, right? If OYO is being rented out at 800 rupees, right? So essentially, because of these local supply chains, they can cut down their prices very, very easily. There is no economy of scale happening at OYO, and customers do not get super excited that, you know what, I'm going to go and stay with OYO, I'm going to Instagram my pic, I'm going to Facebook my pic, this, that. No one cares about that brand. So the issue with OYO is that OYO has literally zero pricing power. They cannot increase their prices. Their game plan was that, okay, you know what, we are going to squeeze the suppliers. We are going to cut their margin. That is how we are going to become profitable. Again, those suppliers will start their own hyper-local branches and that will further eat into OYO's market share. So OYO is not able to make money off customers and OYO is not able to make money off suppliers. So they are stuck somewhere in the middle and therefore they are exhibiting so much loss. Now you might say, Akshat, you are just ranting. So can you show some proof? Okay. So here is an article by Mint and I am quoting an excerpt out of it. So it says that OYO faces structural challenges in China where budget travelers are increasingly opting for better chains like Kwanji and Atour hotel groups. Budget hotels too have begun to offer more value-added services and the space is starting to look crowded with the entry of this and this company. So that is what I'm trying to tell you, that these hyper-local supply chain develop with time and they are able to do it more effectively because they understand the local context. They don't need to undertake mindless expansion. Now you might say, Akshat, what do you mean by mindless expansion? So okay, this brings us to the fourth issue that OYO is facing. They are facing issue called as refinancing. Okay, so let me help you explain this by giving you a simple example. So OYO, when it started out, so let's assume that it only had 3 properties, right? That it was trying to manage only 3 properties, let's say. Now they were giving them long-term contracts. So their fixed cost was, let's say, 100 rupees. Okay, 100 rupees per property times 3. So 300 rupees. Hypothetically, right? We are just giving an example. Now suddenly what they said was that, you know what, we are going to expand rapidly. Let's increase this to 3 times 100. So we will increase this. So this fixed cost amount will also go by 100. If you are expanding capacity by 100 here, this fixed cost will also become 100 times more. Now what is happening is that the return on asset or ROCE is not positive at all. So it's not as if that OYO is making money and then it is pouring that money for this expansion, right? This is expansion. So they are not able to do it. So how are they getting this money, right? If I ask you that question, how are they getting this money? They are getting this money by selling equity, right? Selling equity or taking a loan. Now what has happened is that now as long as people believe in this growth story that okay, OYO is going to become like $100 billion business and $500 billion business, this equity will keep on getting stronger and stronger and stronger, and they can make more money by selling this equity. But what has happened now is that due to COVID, this entire game that at one point OYO was valued at $10 billion, now it has come down to $9 billion. So essentially this 10% erosion of wealth has already happened in its equity. Now if OYO goes and try to sell this equity, they are going to get less money. So essentially in simple terms, what is happening is that their cost of capital, COC, has gone up a lot. So now it is stuck in a situation where it cannot sell even more equity to finance its ongoing project. Why it needs to finance its ongoing project? Because it's a loss-making company. The current operations are not able to fix its losses and allow it to expand. Forget about expansion. They are not even able to recover its current operations from that angle. Massive number of people were fired from OYO when the 2020 COVID crisis hit. Now to top all these structural issues that OYO is facing, COVID has accelerated the downfall of this hospitality industry in total, and especially for these debt-laden companies like OYO. They are left with literally no option but to go to the market and start raising money, and that is what they are doing. Now very interesting finding here, and I will talk about the IPO in a minute. But very important point that I want to show is that many of you might be questioning me that, hey Akshat, this is like a temporary situation and COVID problem will go away, everyone will start traveling and they will start booking OYO and OYO will become profitable. Okay. So again, let me take back to that same argument that OYO is already a mature company. I showed you that statistic that out of a total serviceable market size of $1,267 billion, $1,267 billion, OYO is already present in a serviceable market of $772 billion. It's not as if that it's a small startup. It's already a big startup that has already expanded to a lot of geographies and it is exhibiting unprofitable growth. They have not figured out a business model which is giving them money. Their equity value has shrunk. They cannot raise more money profitably by selling more equity. So the option remains that, hey, let's go to the IPO market. And if you actually read the IPO filing, this is what the IPO says. A part of the net proceeds are proposed to be used for repayment of debt worth $330 million. Funding organic growth is $392 million. They are going to use 40% of the amount to repay its debt. Now you tell me that you run a hotel, right? And you are making losses after losses. Then you go to our favorite bank, SBI. You tell the manager that, hey manager, please give me loan because I want to repay my loans. Now you tell me, is that like a productive use of the fund? Many would argue yes, but it makes me very uncomfortable that OYO is going to the IPO market with the primary intent, with one of the primary intent being that, hey, that we are going to reduce our debt. This is a super high debt business, super risky. Even their own investors understand this. Why am I telling you this? Okay, this is again a statement that you can read. The founder Ritesh Agrawal along with his company will be retaining 33.16% stake, whereas other major investors, please note, other major investors like SoftBank, Grab, Hazu Hotels, Global IV Ventures, etc. are planning to offload a part of their stakes. Now you don't know how much stake they are going to offload. So essentially this entire IPO game by OYO is just a way to repay its debt and give exit to existing investors. I'm not sure even their exit will be profitable or not at this juncture, but super risky stock to invest your money in. Will I be investing in this IPO? No. Does that mean that you will not make any money in this IPO? I don't know. Because IPO listings work in a very weird fashion. Majority of the time, they are not driven by fundamentals or valuations. They are driven by speculation. Everyone speculates that, okay, corona problem gone. Invest in a company like IPO, it will climb up. Okay, but tell me fundamental reasons why it will climb up. Because imagine the worst case scenario that you put 100 rupees in OYO IPO, and if for some reason the stock on the listing day does not give you any listing gains, you are stuck with it. At what point will you sell? You have no data. You don't even know when to exit that stock. Then you will keep on fretting. Hey, should I be holding it at like 20%, 30%, 40% loss? So therefore, doing that risk reward equation in IPOs is very, very difficult to do. Technically, I would not advise you to invest in companies that are not making money or have had no history of making money. That is the worst part. That it's okay for a company to be in a temporary loss, not a problem there. Provided that they have shown some consistent history of making money somewhere, because that proves that the market is willing to pay for their services. It's a proven business model, because at the end of the day, what is a business? Business helps you make money and add value to others. That is what it is. And it should be done in a sustainable manner. There is no point in selling that 10 rupee waffle the way I used to get it. I used to be super happy, but eventually it was an exit game for Uber Eats. They exited. That is what happened. That is the intent with which the entire company was built, in my opinion. It was not done with the intent of adding value, or it was not done with the intent of adding good tech, all that stuff. All those are bells and whistles. Please do simple analysis, high capex business, so much debt, raising money just to give investors an exit and repaying the debt. What sense does that make? Is it adding value to you as an investor? Why would you want to fund a company that is using your money to repay its previous debt? So yeah, so that is my analysis. So very happy to hear contrarian views. These are my views. This is not an investment advice. Please do your own due diligence before advising. I am just sharing whatever I will be doing. So I hope you enjoyed the video. I will see you the next time.